It's no surprise supplies of crude oil jumped while gasoline inventories fell sharply in the 3 weeks since Hurricane Harvey hit the Texas Gulf Coast's refining hub. But traders may be surprised by how quick oil prices have rebounded. West Texas Intermediate oil futures took an immediate hit from Harvey, which made landfall on the Texas coast on August 25, as refiners probably didn't run about 60 million barrels of crude that otherwise would have been processed, said Tom Closa, global head of energy analysis at the Oil Price Information Service. As much as a quarter of U.S. refining activity was shut down because of the hurricane, mostly due to damage caused by extreme flooding. As a result, supplies of gasoline and other petroleum products were drawn down sharply, while demand for crude oil was curtailed, prompting a backup of oil inventories. In Harvey's wake, the Energy Information Administration reported a 12-week jump in U.S. crude oil supplies totaling more than 10 million barrels, with more than half of that reported for the week ended September 8. But this week, prices for U.S. benchmark West Texas Intermediate crude USCLV 7 traded as high as $50.50 a barrel on an intraday basis, the highest since May. Brent crude, the global benchmark UKLCOX 7 nearly touched $56 intraday, a level at HASNT seen since April. WTI, in particular, showed a relatively quick turnaround from a dip below $46 in late August. We'll almost certainly see the spread between WTI and Brent narrow, and we'll see U.S. companies smash the record for crude exports sometime in the next 40 days, said Closa. Refineries have also seen a gradual recovery, with about 9% of U.S. refining still down or not restarted, according to data from OPIS parent company IHS Markit as of late Tuesday. Meanwhile, operators in the interior states, away from the coasts where some operators are struggling after the floods, are running full out, said Closa. He also pointed out that a number of refiners have deferred maintenance until 2018. Adding further to the potential for tighter crude oil supplies and higher prices, data from the Baker Hughes BHGE 0.64% Friday showed that the number of active U.S. oil rigs fell for a second week in a row. But WTI oil prices have managed to climb even before any actual pullback in crude inventories, as a report from the International Energy Agency on Wednesday showed that compliance with the Organization of the Petroleum Exporting Countries oil production kit agreement improved in August. The Paris-based agency also raised its oil demand outlook for this year. Meanwhile, news reports said that OPEC heavyweight Saudi Arabia is floating the idea of extending the output cut pact past March of next year. The recent rally for oil prices is a welcome respite, but most remain cautiously optimistic and, in fact, any indications that OPEC may consider not extending cuts would undoubtedly shatter any price appreciations, said Rich Pontillo, senior director as Nasdaq Advisory Services. A committee monitoring compliance with the production kit agreement is set to meet on Friday. It remains unclear if members will announce any substantial updates or if they will wait until the OPEC meeting in November, said Pontillo. For now, however, WTI prices haven't been able to settle at or above the key $50 mark, and it might not move much more than $10 in either direction from Friday's settlement of $49.89. We see little reason to expect prices to trade below $40 or above $60 for any protracted period, said Katrina Lamb, head of investment strategy and research at wealth management firm MV Financial. The major storyline in world oil markets continues to be shale, she said. U.S. producers will continue to produce, cost efficiencies will continue to make their cost thresholds more competitive, said Lamb. There will be very little room for effective policy management at OPEC, regardless of whether they try to extend out the production cuts or throw in the towel and try again to sacrifice profits in the name of market share.